Small businesses are the pulse of every community. They bring people together, create opportunities, and drive growth. Chase for Business helps business owners like you with personalized guidance and convenient digital tools all in one place. With that guidance and your determination, you can take your business farther and help build a brighter future for your community. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. J.P. Morgan Chase Bank, N.A. Member FDIC. Copyright 2026. J.P. Morgan Chase & Company.
This podcast is brought to you by Wise, the smarter way to manage your money internationally. If you're getting a headache from juggling different currencies and different bank accounts in different countries, there's a better way to receive money in the currency you need without the slow transfer times or hidden fees. Meet Wise, the savvy way to handle your money internationally. Hold balances in up to 40 currencies with the mid-market exchange rate on every conversion, whether you're receiving payments from tenants abroad, earning as a digital nomad, or converting dividends from your international investments. The Wise multi-currency account is for you. Be smart. Get Wise. Download the Wise app today or visit wise.com. Terms and conditions apply.
You need to make a huge presentation in an hour. Luckily, Adobe Acrobat Studio uses AI to take all your documents and generate a presentation with a single click, building slides faster than ever before. So if you need a last-minute pitch deck, do that with Acrobat. Need to level up your presentation design? Do that with Acrobat. You have 30-plus documents that need to be simplified into a proposal? Do that with Acrobat. Learn more at adobe.com/do-that-with-Acrobat.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look at what we can expect from Homebuilders in the months ahead. I'm Nathan Hager in Washington.
I'm Caroline Hetker in London, where we're looking ahead to the UK jobs numbers and asking whether AI is starting to affect productivity.
I'm Doug Krisner, looking at the outlook for Chinese consumer spending during the Lunar New Year holiday.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with Homebuilders. Recently, we heard the Trump administration is exploring an antitrust investigation into the industry as the White House sharpens its focus on tackling the housing affordability crisis. For more on what we can expect from Homebuilders in the months ahead, we're joined by Drew Redding, U.S. home building analyst for Bloomberg Intelligence. Drew, how do you see the backdrop now in the new home market?
So in the new home market, the backdrop is still a little bit challenged. We have made some progress on affordability, which, as we all know, has been the primary constraint for buyers out there in the market. Mortgage rates are down about 100 basis points from where we were last year. But what we've heard pretty consistently from the builders that we talk to is that it's not just about affordability. It's also about sentiment. You have more consumers out there in the market who may be concerned about the direction of the economy, the outlook for employment. So there's not a lot of urgency. And, one of the things I think that's happening is you have a lot of people sitting on the fence who are saying to themselves, look, I think rates might be coming down. I think home prices might be coming down. So I'm going to take a wait and see approach. Now, with that being said, we think that the market can grow this year from a sales perspective. A lot of that's going to be driven by community count growth. So we actually have new home sales rising in the mid-single digit range, but we do think that housing starts, which is probably the most widely followed measure in the new home market, will be flattish because builders want to work through their standing inventory before putting new product in the ground.
So that sentiment damper you're talking about, is that across the board, or is it just in the luxury sector, the low to middle income sector? How does it look that way?
Yeah, so I think we've heard pretty much across the board from builders that sentiment has been a major issue. When you start to look at customer profiles, certainly the entry level has been a little bit more pressured. If you think of that buyer, they're typically more sensitive to fluctuations in mortgage rates and monthly payments compared to, call it a Toll Brothers, who is more exposed to the luxury end of the market where, the buyer is more affluent. and doesn't have those same rate considerations. But you have to think of housing as an ecosystem. So while the higher end may be doing better, they still need to see movement at lower price points in order to facilitate those move up home sales.
So if builders are sort of working through this despite those sentiment concerns, what could that mean for their margins?
Yeah, that's a great question. And it's probably the number one thing on investors' minds, because margins have come in pretty significantly over the last couple of years. And the reason is because builders have had to be pretty aggressive in their use of mortgage rate buydowns in order to stimulate demand. Now, it has helped them maintain sales levels. If you look at, how new home sales has trended versus the resale market, they've held up a lot better, but they're having to pay a lot in order to buy down these mortgage rates. And what we've heard from those that have reported earnings so far is that they expect the use of incentives is going to remain elevated through the spring selling season, because there's still, a lot of challenges out there.
You've seen a lot of focus from Washington on the housing sector as well. These ideas about limiting institutional purchases of single family homes, maybe allowing more use of 401ks for a first time down payment, things like that. Does that affect your view on the outlook for the housing market if some of these policy ideas come into fruition?
Yeah, so policy has certainly become the biggest wild card, I think, for home builders in 2026. They've been squarely in the crosshairs of the administration for 4 or 5 months or so, given, the heightened focus on affordability. Outside some of the things you discussed, like the proposal to ban institutional purchases, we really don't have a lot of concrete ideas. We've got plenty of tweets and leaked news stories, but nothing substantial yet. And I think, we could hear something at the State of the Union in a couple of weeks. What that may be, I don't know. But, the administration has been critical of the large public home builders in particular. They've talked about their land holdings, saying, they own 2 million lots. They need to start building on them. And they've even threatened to withhold liquidity from them if they don't start building. They've said that builders shouldn't be buying back their stock, which has become a big part of their business model. And then the other piece that we think could be a risk going forward is, the discussion about mortgage rate buydowns. There were some tweets out there saying that they're artificially propping up prices. So it does seem that they're looking at everything. And I think ultimately what it does is creates a more volatile operating environment and two-way volatility for the stocks.
Are you seeing the industry actively making preparations for whatever could come down from the Trump administration, Drew?
Yeah, so I mean, at this point, it's kind of just business as usual. We've heard from most of them that, really since the end of last year, they've been working alongside the administration and policymakers in a collaborative manner to try to come up with solutions, whether they be demand side stimulants or a way to get more supply into the market. So as of now, it's business as usual. We'll have to wait and see what comes down the pike.
Thanks for this, Drew. Great having you on with us. That's Drew Redding, Homebuilders analyst for Bloomberg Intelligence. Let's take a look now at some stocks making news in the week ahead. I'm Nathan Hager, joined by Bloomberg News equities reporter Alexandra Semenova. And Alex, we're going to hear from some big ones this week in terms of the earnings. The biggest name in retail is reporting on Thursday. What are we expecting from Walmart?
Hey, Nathan. So it is indeed going to be another busy earnings week. Walmart is such a bellwether of low and mid-income consumers, so that's going to be an important company to watch. It is scheduled to report earnings results before the bell on February 19th. And something to note ahead of its earnings readout is Walmart just saw its market cap eclipse the $1 trillion mark on February 3rd for the first time ever. This is something that you don't see from retailers. It's something you typically see from tech giants. So Walmart is now in a category typically occupied by big tech heavyweights such as Nvidia and Alphabet Inc. And Walmart is a longtime favorite, of course, of bargain hunting consumers, which is why it has been doing so well. It has flexed its massive scale and supplier network to keep prices low and grab market share across various income levels. And not only has Walmart maintained its appeal to households looking for value, it's also been recently drawing some new, wealthier shoppers as well with its online business. So when we get to those results, some of the key metrics to watch will be same-store sales performance. That is going to be an important metric to monitor growth for long-term revenue and profit expansion for the company, contribution from higher margin businesses too, and inventory management. And I want to point out that the stock is up something like 19% year to date. So the bar is pretty high going into these results.
Yeah, certainly with $1 trillion valuation now, and with the fact that Walmart recently relisted to the NASDAQ, it really does seem like they're leaning into this tech side of the story. But we're also going to hear from another name that we think of more traditionally on the tech side. DoorDash reports on Tuesday, right?
Yeah, it does, Nathan. So I'd say for this company, the main thing investors will be watching is signs that it can monetize on heavy CapEx spending. So during the last earnings report from DoorDash, it took a record plunge after the company said it's going to spend more on investments next year to build new products and bolster internal tools, which really weighed on its earnings forecast. These increased costs contributed to a muted fourth quarter forecast for adjusted EBITDA specifically, with the company expecting that metric to be around $710 million to $810 million. So watch that number. Also watch order growth, which is currently exceeding that of some of its online delivery peers. And it's also supposed to get a potential boost from Deliveroo, which it acquired recently. So that's going to be something to monitor during those results. And then it is also expanding into new categories beyond just restaurant delivery. So groceries and convenience, which are expected to aid with consumer retention. And ahead of the report, some of the big Wall Street firms did lower their price targets on the company. Bank of America was one of them, lowering their price target to $260 a share from $305 a share, but it did still maintain a buy rating. Goldman Sachs added DoorDash actually to its U.S. conviction list, so that's pretty positive. And one more thing to note is, of course, DoorDash and Uber just lost a bid to block a New York City law requiring a tipping option to be presented to customers at checkout from going into effect. So it's likely we're going to see perhaps management commentary on that front. DoorDash has been having a pretty hard start to the year. It's down something like 27% so far.
Well, another big name we're going to hear from is a bellwether on the agriculture economy. Deere has really been on a tear since the start of the year, Alex.
Yeah, it has been a really interesting company to watch, given the fact that it's kind of been at the center of Wall Street's big rotation trade into sectors outside of technology. So it's actually trading at a record high now amid a rally that has come as interest rate cuts and strong U.S. growth push investors into sectors of the market closely linked to the health of the U.S. economy. So Deere sells construction equipment in addition to its iconic farmer machinery, and that's been an industry that up until recently was really struggling. Investors are betting it could get a boost from the Fed's monetary easing and some data that showed that the U.S. economy is expanding at a healthy pace. So when the company reports earnings, Wall Street will be looking for any update on its industry outlook. Investors are still waiting for a rebound in the U.S. farm economy specifically, so something that would spur farmers to buy new tractors and other equipment. Deere's shares had hit a record last May on the same hopes, but that turned out to be a head fake. So the key question is, will this also be? The farm economy is projected to extend its downturn actually through 2026 so far, expecting net farm income to fall by 1% according to the USDA. And Deere also said in November that it expected industry sales of large equipment to fall 15% to 20% in the US and Canada. So we're going to see what it says on those fronts. It is up nearly 32% year to date. Yet again, a company that has a really high bar going into report.
Yeah, certainly sounds like it. Thanks for this, Alex. Great having you on with us.
Great to be with you.
That's Bloomberg News equities reporter Alexandra Semenova. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to jobs numbers in the UK. Is AI starting to affect productivity? I'm Nathan Hager, and this is Bloomberg.
Support for the show comes from Public. Public is an investing platform that offers access to stocks, options, bonds, and crypto. And they've also integrated AI with tools that can assist investors in building customized portfolios. One of these tools is called Generated Assets. It allows you to turn your ideas into investable indexes. So let's say you're interested in something specific like biotech companies with high R&D spend, small cap stocks with improving operating margins, or the S&P 500 minus high debt companies. Chances are there isn't an ETF that fits your exact criteria. But on Public, you just type in a prompt and their AI screens thousands of stocks and builds a one-of-a-kind index. You can even backtest it against the S&P 500. Then you can invest in a few clicks. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Ad paid for by Public Holdings. Brokerage services by Public Investing. Member FINRA SIPC. Advisory services by Public Advisors. SEC registered advisor. Crypto services by Zero Hash. Sample prompts are for illustrative purposes only, not investment advice. All investing involves risk of loss. See complete disclosures at public.com/disclosures.
We buy insurance for peace of mind, but every year millions of claims are denied. Not because people did anything wrong, but because their policies quietly excluded what happened. Insurers know every detail. Policyholders rarely do. That's why My Policy Advocate exists. For just 27 cents a day, their platform reads your policies and explains where you are vulnerable. They don't sell insurance, they deliver transparency. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Go to mypolicyadvocate.com.
Finding the right promotional products can feel overwhelming, but with 4imprint, it can be easy. They call it 4imprint certainty, which means the process is stress-free, straightforward, and backed by real peace of mind. Not sure what promo products to order? No problem. You can get free samples, product guidance, even free help with your logo, so everything can meet your expectations. Need options? They've got thousands, including branded apparel, drinkware, outdoor, and all the trade show essentials. And when your order arrives, it's backed by their 360-degree guarantee. That's 4imprint's promise your order will be packed with care, show up looking great, and right on time. In a rush, 4imprint has quick turnaround options too, to help you hit your deadline. Whether you're prepping for an event or just refreshing your promo lineup, 4imprint helps you get it done. Head to 4imprint.com to explore. That's 4imprint.com. 4imprint. For certain.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in our program, we'll look ahead for what to expect during the 9-day Lunar New Year holiday in China. But first, the UK economy is facing a tricky mix of slowing growth, stubbornly high unemployment, and mounting global uncertainty, from trade tensions to tariffs and political turmoil. But amid the gloom, there's a growing debate over whether artificial intelligence could help lift productivity and offset some of the weakness in Britain's labor market, even as questions mount about whether the technology is already displacing workers. After recent GDP data out of the UK showed sluggish growth, we get fresh jobs data from Britain next week. Let's get more now from Bloomberg Daybreak Europe anchor Caroline Hepker in London.
Nathan, AI is talked about as both a coming storm but also a potential solution to Britain's growth woes. The UK's unemployment rate has climbed to near COVID levels since Labour took power in 2024. But ahead of the UK jobs data in the next few days, there is a new quirk in recent data. Some economists increasingly think that productivity may actually be improving, and they wonder if artificial intelligence adoption may be playing a part. The Bank of England Governor Andrew Bailey is one of them.
I'm an optimist on the potential for AI and robotics to move the dial on productivity and thus on economic growth. I'd like to think, though, that I'm a realistic optimist. My impression is that we've made more progress so far applying AI to well-defined task-based work rather than some of the more ambitious goals. But I'd also say that I don't find that at all surprising.
So, is AI a panacea, and what impact is it actually having on the UK economy? Joining us now in studio is Bloomberg's UK economy reporter Irina Angel and our Bloomberg opinion columnist covering technology, Parmi Olsen. Welcome to both of you. Thanks for being with me. Irina, can I start with you just on the actual figures? What are we expecting from the UK jobs numbers in the next few days?
So next week we'll get the jobs report for December, and the unemployment rate is actually expected to edge up again. It's now at 5.1%. Some economists who are surveyed by Bloomberg think it'll go up to 5.2%. And this is just so you have a sense of how important this is. It's the highest since sort of COVID times, 2021, 2020. And it will get worse in the next months, but perhaps not for much longer. The Bank of England kind of sees unemployment peaking at 5.3% in spring. And, now this is starting to raise important questions about the jobs costs of their, fight to bring inflation back to the 2% target.
The past year has been quite difficult for the labour market in the UK. What's your analysis about why that is?
Well, it's all pointing to one thing. It's the payroll tax rises. Chancellor Rachel Reeves's 26 billion payroll tax rises, and those came on top of large consecutive increases in the minimum wage. And the country has lost almost a quarter of a million jobs after these payroll costs were increased in Reeves's first budget in October 2024. And since then, employers have blamed them for job cuts and hiring freezes in key sectors like retail and manufacturing.
There's been a lot of talk about the number of young people who are not in work or employment or training of any kind. That's got quite a lot of attention. But how isolated is the issue with jobs when you segment things by age or gender or skill set?
Well, most of this increase in unemployment that I was just talking about has been due to a lack of hiring so far rather than mass layoffs. So, of course, this impacts young people looking for their first job or just other people, moving out of economic inactivity straight into unemployment. And it's actually very interesting that because men are becoming unemployed at a faster rate than women. And, of course, in particular, young men, that's a big problem, but men in general. And it seems like that hiring freezes and layoffs fell particularly hard in male-dominated sectors. So, construction, manufacturing, but also IT. And this is all kind of helping reform because while reform did not stand out among unemployed voters at the general election, it has become the dominant party for this group over the past 6 months. And it's particularly unemployed men who turn to reform. We have data from More in Common that showed that more than 40% of men who are out of work support reform, and that's double the level in July 2024 and 10 points more than women.
Gosh, that's interesting, isn't it? So the political ramifications then from the data. I want to layer into that outlook what AI might mean, because I note that the Technology Secretary, Liz Kendall, was speaking at Bloomberg's headquarters right here in London, talking about how the government's going to use AI to turbocharge different industries in Britain and pledging this idea that there will be AI training for all UK employees. Parmi, you've been covering AI companies and how their tools are really starting to unsettle the world of business, the world of work. What kinds of products, I suppose, first of all, are we actually starting to see being used? And then, maybe we'll think about what that means for employment in a minute.
Well, most people are using chatbots already, right? I think it's something like 800 million to 900 million people use ChatGPT on a weekly basis. That's something like 10% of the global population every week are using these tools. But the most recent updates have been agentic AI. Of course, you might have heard that term, agent, a lot last year. It was very much hyped. Unfortunately, that didn't have much to show for it. Only a few companies actually released anything. They were a little bit unreliable. But actually, just in the last few weeks, we've seen a couple of product launches of these AI agents. And this is different to a chatbot. This is AI that can not just give you information, but carry out tasks for you. So the one that the market really got spooked by was a product called Claude Cowork, which came from a company called Anthropic. They were spun out of OpenAI a few years ago. And I've used it myself. I pointed it at some files on my computer and got it to create a PowerPoint presentation out of it, create a spreadsheet of all the people and all my interviews with all their areas of expertise, stuff I'd been wanting to do for years, but just didn't have the time to do.
Wow.
It was even answering my LinkedIn messages. I didn't even have to go to LinkedIn, and it would just answer them for me. So those are just some examples of the kinds of things they can do. And this is what I think is kind of rattling the markets a little bit, is this sense that, okay, some of these tasks that certain jobs are doing could well be under threat.
The thing is, traders and investors are reacting pretty strongly to the idea of these products, but they've not been fully adopted yet. As you say, lots of people are testing them out. Lots of businesses are trying them out, and they haven't really claimed much market share yet. But I suppose people are worried about whether that's coming or why that is.
I think so. I think you're right. I think people just kind of want to get ahead of whatever disruption is coming and ride that wave. But this is so typical of the market, right? Like just a few months ago, everybody was freaking out that we're in an AI bubble. And now the sentiment, the narrative has totally shifted to we're practically in the AI singularity. You know, it's like maybe not to that extent, but it is funny how the pendulum has swung so far the other way. If you remember in January last year, there was a huge drop in the share price of big tech companies when China's DeepSeek came out because there was a belief that that was going to threaten the status quo of all the infrastructure and data centers that was being spent by big tech. Now, of course, that was an overreaction. I think we're seeing the same thing here, a little bit of an overreaction, but there's truth to it. When people are selling off stocks like Salesforce or some of these other enterprise software makers, there is some truth that the application layer that those software makers have, that bit of their business is under threat, I think, from these new AI agents that are coming to market.
Okay, so let's bring that together then with the idea of jobs here in the UK. How far away is the future where artificial intelligence does actually make workers redundant? Because we're starting to see bits of reporting around that and bits of data in Britain.
Well, the obvious casualty for now, maybe it's not quite showing up in the data yet, is the graduates, entry-level workers, whose companies are told, treat your AI like an intern. So they do. And that works really well. And then they don't need to hire interns or junior analysts or junior researchers. And I think that might just be the starting point. But I think it's I don't think it's going to be as simple as just jobs get replaced. I think jobs are going to change. So, for example, I was talking to the head of Zapier, which is a big software company in the US. And he was saying that the way they build product now, they used to have 3 people who would be on a team. And it's a very classic structure called EDP, or EDM. So it's the engineer, the product marketer, and then the designer. Now, instead of 3 people, they just have 1. But that one person has to cover all those 3 different areas. So the titles have been squished together into one person who's using AI to kind of augment themselves. It doesn't mean the other 2 people have been fired. They're just doing different things. So I think we're going to see a mixture of that, of roles just changing and morphing and blending together, but perhaps also certainly elements of hiring freezes. I mean, there are some people who've been using this new Claude plugin for legal work. And one person told me that they weren't using their fractional lawyer anymore for anything up to a commercial contract worth $50,000. You know, anything higher than that, you do need a human. But if it's kind of low stakes, they were using the AI now. So, of course, that is a job not going to a human. So we're seeing, I think, a kind of mixture of those things happening.
Yeah, anecdotally, I've certainly seen it with people I speak to that they are feeling that change. And I will point to one bit of data. Morgan Stanley in the last few weeks has talked about AI leading to an 8% net job loss over the last 12 months in the UK. So there's some tiny bits of research out there. Irina, are we seeing any signs that AI is starting to affect the UK labour market? Is it, people recently graduating? What sorts of jobs might be affected first?
I think the problem is not necessarily job cuts, but the lack of job creation in the UK. So, that Morgan Stanley research, it's showing the UK is losing more jobs than it's creating because of AI, and it's doing so at a faster rate than, countries like the US or Japan or Germany. But if you actually look at the data, the UK is sort of losing jobs at the same pace as the other countries. So it's kind of like losing jobs at the same rate as Germany. It's just creating way fewer jobs thanks to AI. And some of that is also due to higher employment costs here that, are not really... it's not really AI is almost coming in as a solution for companies to deal with this increase in the cost of employing a human, and to be sure, like, there's also some productivity gains that are coming as a result of adopting AI, and there are this is, one for the AI optimists, like the Bank of England governor, Andrew Bailey, the fact that, these companies are actually changing how they do things after adopting AI. And, maybe the UK is about to see a productivity, to finally escape its productivity trap. But the data does point to the fact that there are some job losses to come, and the cost of this may be a bit too high, or we're not ready to deal with it yet.
My thanks to our UK economy reporter Irina Angel and to our Bloomberg opinion columnist covering technology, Parmi Olsen. Thank you so much. And we'll have full coverage and analysis of the UK's jobs data. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to Lunar New Year festivities in China. I'm Nathan Hager, and this is Bloomberg.
Support for the show comes from Public. Lately, it feels like there are two types of investing platforms. Some are traditional brokerages that haven't changed much in decades, and others feel less like investing and more like a game. Public is positioned differently. It's an investing platform for people who are serious about building their wealth. On Public, you can build a portfolio of stocks, options, bonds, crypto without all the bugs or the confetti. Retirement accounts? Yep. High yield cash? Yes again. They even have direct indexing. Public has modern design, powerful tools, and customer support that actually helps. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Ad paid for by Public Holdings. Brokerage services by Public Investing. Member FINRA SIPC. Advisory services by Public Advisors. SEC registered advisor. Crypto services by Zero Hash. All investing involves risk of loss. See complete disclosures at public.com/disclosures.
Here's a paradox. We buy insurance for peace of mind, yet the very policies we trust can deliver the biggest financial shocks. Across America, millions of claims are denied every year, not because people did anything wrong, but because policies quietly excluded the things that happened. The psychology of trust tells us we assume the contract is fair, but in insurance, the information gap is massive. The insurer knows every detail of what's covered. The policyholder rarely does. That's where My Policy Advocate comes in. For just 27 cents a day, their platform reads your policies and shows you in plain language where you're vulnerable. They're not selling insurance. They don't do that. It's about transparency, giving ordinary people the same understanding insurance companies have had for decades. Because when you know what's really in your policy, you can plan, protect, and avoid surprises. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Visit mypolicyadvocate.com today. Peace of mind starts with knowing the truth. mypolicyadvocate.com.
Finding the right promotional products can feel overwhelming, but with 4imprint, it can be easy. They call it 4imprint certainty, which means the process is stress-free, straightforward, and backed by real peace of mind. Not sure what promo products to order? No problem. You can get free samples, product guidance, even free help with your logo, so everything can meet your expectations. Need options? They've got thousands, including branded apparel, drinkware, outdoor, and all the trade show essentials. And when your order arrives, it's backed by their 360-degree guarantee. That's 4imprint's promise your order will be packed with care, show up looking great, and right on time. In a rush, 4imprint has quick turnaround options too, to help you hit your deadline. Whether you're prepping for an event or just refreshing your promo lineup, 4imprint helps you get it done. Head to 4imprint.com to explore. That's 4imprint.com. 4imprint. For certain.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. We go to China next, where Lunar New Year festivities are set to kick off. The 9-day holiday will drive spending on travel, dining, and gift giving. For a look ahead, let's get to Doug Krisner, host of the Bloomberg Daybreak Asia podcast.
Nathan, the Lunar New Year Holiday, or Spring Festival, is one of China's longest holidays, and this year it will usher in the Year of the Horse. Festivities will run for 9 days from February 15th. That's a day longer than usual. And as usual, the focus for markets will be on consumer spending. Now, we know the Chinese economy continues to struggle, largely due to weak domestic demand. For a closer look at the holiday mood, let's bring in Bloomberg's Shirley Zhao. Shirley covers consumer companies in the region with a close eye on luxury goods, and she joins from our studios in Hong Kong. Thank you for being here. First of all, Shirley, I want to know about the level of confidence among consumers.
I think people are relatively optimistic because although China is in an economic slowdown and people's spending power has not been as strong as before and people's spending appetite has been weakening, but Lunar New Year is one of China's biggest holidays, and people tend to stay in the country instead of traveling outside because the holiday is all about, spending time with your family. So it's like Christmas in the US or in Europe. It's a big holiday and people tend to want to spend on food and drinks, on, big meals outside. So people in the food and drinks industry, at least, are relatively positive about the outlook of Lunar New Year. But how much it may grow from last year or whether it will grow at all, it remains to be seen because, as I said just now, people's spending appetite still remains relatively weak in the broader economic slowdown.
So if a consumer, let's say, were to make the choice to travel abroad or offshore somewhere, what destinations have become popular? I'm thinking Korea, Japan. Is that likely? Maybe even a place like Vietnam?
Yes, for people in mainland China, Korea has become one of the hottest destinations for people to travel outside, maybe in the latter part of the holiday, because at the beginning of the holiday, everybody will stay home and spend time with family, and then they will visit their neighbors and relatives. So the first few days, people tend to stay within the country. But in the second half of the holiday, some people may choose to travel outside, and Korea has become a really hot destination. And Japan used to be a hot destination as well, and especially when yen is so cheap now. People should have, chosen Japan. But unfortunately, since China and Japan got into this big dispute over Taiwan late last year, China has instructed airlines to cut their flights or even halt their flights for a prolonged period of time. So flights were really limited in mainland China for people who want to go to Japan. And, under this rising nationalism and domestic pressure, a lot of people would choose to go to other places than Japan. So we would say Korea and definitely Southeast Asia, places like Thailand and Vietnam would be preferred destinations for mainland Chinese travelers. For travelers from Hong Kong, Japan remains a big destination, and other places like Taiwan and Korea and Southeast Asia.
In addition to eating lots of good food, gift giving is a major part of the festivities, and red envelopes in particular. Talk to me a little bit about the red envelope and how some e-commerce companies are trying to convert that type of gift giving into online commerce.
Right. So it's interesting because Bloomberg Hong Kong so we have a weekly newsletter, and this week's newsletter is actually a review of red envelopes by different brands and financial institutions. So, for example, Hong Kong's flag carrier Cathay Pacific has issued a really fantastic set of red envelopes featuring the company's history and their milestone plane models over the 80 years of its history. So the red envelope is definitely a huge tradition. And if you have children, or if you will go to meet your friends' children, then you're supposed to give red envelopes with money in it to them because they are junior to you. But your parents or people who are senior to you will give you red envelopes with money. So that's been a huge tradition in China and Hong Kong. But over the past few years, e-commerce has developed so fast in China. It's, so ubiquitous everywhere. And everybody, it's got to a point that if you go to China today, if you want to use cash, it's very difficult because very few places accept cash anymore, or they don't have changes for you. So everyone is paying online using e-commerce platforms. And in fact, my parents and my relatives are giving me money via online red envelopes. So we can see, there's a huge shift of people, of this money gifting from offline to online.
I know you focus a lot on luxury goods, and I'm wondering about the outlook for luxury sales, given the state of the economy and how consumers are feeling about their finances. Is there, in your view, a risk that spending on luxury items, particularly on those well-known fashion brands, is a little on the soft side?
Yes, over the past 2 years in China, the trend is definitely that people are becoming more cautious and selective when it comes to buying big ticket items, including like jewelry, watches, and leather goods, all those luxury brand items. The trend in China is that people are now becoming more aware of their own needs and their own lifestyle, and they don't have much money, or they don't feel rich enough for them to buy a huge amount of luxury stuff. So they're becoming more selective. They are not only looking at brand names, they're also looking at whether they identify with the brand stories, the brand philosophy, and whether these brands can elevate their lifestyle, can make them feel better. So in the past, you could see that people would just go to any luxury brand stores because of the brand names. People thought that, if they bought luxury goods, it could elevate their status. But now people are really choosing very carefully. So luxury gifting could still become a bit subdued in China, but this year, everybody's going after gold like crazy. So I won't be surprised to see that, gold gifting could become a big trend in China during the Chinese New Year because, the gold prices have been going up and up and up.
Right.
And in China, everybody goes into this investment if the prices keep going up, and, everybody pull out if the prices come down. So yeah, there's a huge frenzy over gold in China right now.
We talk about the many ways the Chinese government has tried to tackle the problem of weak domestic demand. And since holiday spending has the potential to provide a bit of a lift to the overall economy, I'm wondering about what the government is doing to encourage consumers to spend more than they would otherwise.
Yes, so the Chinese government has actually focused more on consumption than before. So previously, its focus was on, heavy industries and new industries, for example, like EV and new energy sectors. But it has come to realization that consumption is a big part of economic driver. So it has been issuing for example, consumption vouchers, and it has been implementing policies to encourage people to buy things. So that's a good shift, and it's we have seen the Chinese government doing more in encouraging people to spend in China.
I've learned that much of the gift giving during the Lunar New Year holiday has been described as emotional consumption. We've also seen a tendency to favor experiences rather than goods. Shirley, I'm going to go out on a limb here, so work with me, and I'm going to ask whether gifting stock is something that consumers would ever consider.
Actually, that's a really interesting thought, and I definitely wouldn't mind if people give me, stocks in major Hong Kong or mainland companies. But this is not a trend that I have observed. In fact, in China, I still think that the majority of people don't think stock market being a safe way to put their money in. A lot of Chinese people still think that property is their only way of investment because it's safe, and the prices would be bound to go up. Of course, that was up until a few years ago when China's property market started to crash. So a lot of Chinese people's wealth, because everybody invested in property before the property market slowed down. So a huge amount of Chinese people's wealth was locked up in the property market. That's why people are spending less now, because their wealth is locked up. And even though their income remains unchanged, they still feel that they're not rich. They still feel poor. So that's why people are not spending. Of course, I won't be surprised if China's stock market and China's financial market become better regulated, and if China gives more flexibility for people to invest in different financial tools, stock market could become a big investment for Chinese people, and stock giving could become a trend. But at least for now, I haven't observed this as a big trend right now.
Just a thought. Shirley, thank you so very much, and Happy New Year, by the way. Bloomberg Shirley Zhao joining from Hong Kong. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Tuesday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES. With 4imprint, finding the right promo products can be easy. They call it 4imprint Certainty, which means you get free samples, expert help, art assistance, and their assurance your logo looks great. 4imprint offers thousands of options to choose from, including branded apparel, drinkware, outdoor, and more. And it's backed by their 360-degree guarantee. That's 4imprint's promise that your order will be packed with care and delivered on time. Need your order faster? 4imprint offers quick turnaround options, too. Visit 4imprint.com to explore. 4imprint. For certain.
Here's a paradox. We buy insurance for peace of mind, yet the very policies we trust can deliver the biggest financial shocks. Across America, millions of claims are denied every year, not because people did anything wrong, but because policies quietly excluded the things that happened. The psychology of trust tells us we assume the contract is fair, but in insurance, the information gap is massive. The insurer knows every detail of what's covered. The policyholder rarely does. That's where My Policy Advocate comes in. For just 27 cents a day, their platform reads your policies and shows you in plain language where you're vulnerable. They're not selling insurance. They don't do that. It's about transparency, giving ordinary people the same understanding insurance companies have had for decades. Because when you know what's really in your policy, you can plan, protect, and avoid surprises. Before you trust your policy to protect you, let My Policy Advocate tell you what it really says. Visit mypolicyadvocate.com today. Peace of mind starts with knowing the truth. mypolicyadvocate.com.